One of the most misunderstood phrases in childcare center transactions is when a buyer says they are pre-qualified. I'm Brent Delhamer with Childcare Insight. Because many cases, pre-qualification simply means the lender is willing to continue evaluating the deal. It does not mean financing is guaranteed, and it definitely does not mean the transaction is automatically safe. This creates a lot of confusion for sellers. A seller hears that the buyer is pre-qualified and assumes the financial risk is mostly handled. Then escrow begins, due diligence starts, money gets spent, emotions built, and then suddenly the lender starts pushing back weeks later. And this is where many deals get blindsided. One of the biggest reasons pre-qualified buyers still fail to close is that lenders typically pre-qualified based on limited information early on in the process. Often the lender has not fully reviewed trailing financials, lease structure, payroll trends, updated enrollment data, or complete buyer documentation. The real underwriting usually comes later. I recently saw a situation where a buyer entered escrow feeling very confident because they had already had lender conversations and believed financing looked strong initially. But once the lender fully analyzed the center's financial performance, concerns developed around compressed margins and declining profitability trends. The buyer still wanted the business. The lender became much more cautious. That distinction matters enormously. Another issue is that many buyers underestimate how much operational stability matters throughout escrow. Childcare businesses are highly operational businesses. Enrollment trends, staffing, consistency, licensing compliance, and payroll structure all influence lender confidence. And underwriting simply does not freeze because escrow has opened. I've seen lenders request updated financials late in the transaction and then reevaluate leverage after reviewing softer operational performance. I have seen situations where staffing turnover increased unexpectedly during escrow and created additional lender concerns regarding post-close transition stability. The crazy part is that many sellers assume once the buyer enters into escrow, the difficult part is already over. In reality, underwriting pressure often increases deeper into the transaction. Another major issue is lease structure. This becomes critical in the business-only childcare acquisitions. Buyers may initially appear financially strong, but once the lender fully evaluates occupancy costs, remaining lease term, renewal options, annual increases, and landlord cooperation, the financing picture can quickly change. I worked on a transaction where the buyer looked solid initially and the business itself operated reasonably well. But once lease negotiations slowed and uncertainty developed around long-term occupancy structure, lender confidence weakened materially. The business had not changed. The risk profile had changed. And there is another issue virtually no one talks about. Some buyers become emotionally committed to a center before they fully understand their own financial limitations. Early lender conversations can create a false sense of security. Buyers start envisioning ownership, planning future improvements, and mentally moving towards closing before full underwriting is complete. Then reality starts tightening. Additional liquidity may be required. Debt obligations may become problematic. Working capital expectations may increase. The lender may reduce leverage based on updated operational review. Suddenly, the buyer who felt fully qualified earlier no longer feels as strong financially. I've seen buyers forced to bring in additional capital late in escrow simply because underwriting became more conservative and deeper review. That creates stress for everyone involved. And this becomes even more dangerous when sellers emotionally disengage from backup planning too early. Sometimes owners stop engaging other buyers the moment they hear pre-qualified, assuming the transaction is effectively secure. That can create major leverage problems later if financing weakens unexpectedly. Sophisticated sellers usually understand that a transaction is not truly stable until underwriting, due diligence, lease coordination, and operational review are all progressing together successfully. Not simply because a buyer had an encouraging early lender conversation. Another pattern I commonly see is buyers underestimating how thoroughly lenders review personal financial behavior. Existing debt obligations, liquidity trends, tax documentation, reserve levels, and post-close financial stability can all influence final approval decisions, especially in childcare acquisitions where operational demands are already significant. This is why experienced buyers usually approach financing conversations conservatively. They understand that early lender enthusiasm and final underwriting approval are two very different stages of the process. And honestly, that mindset creates more stable escrows overall. Your homework? It's simple. If you are a buyer, ask yourself whether you truly understand the difference between early lender interest and full underwriting approval. If you are a seller, avoid assuming the word pre-qualified removes financing risk entirely. That distinction alone changes how sophisticated transactions are managed. If you want a confidential discussion about your childcare center acquisition, evaluation, or transaction structure, reach out to us at childcareinsight.com today. Thanks for watching.